Good day, everyone. We are back with another monthly commentary video. No shortage of topics to talk about, a lot of headlines, a lot of moving parts. We're going to talk heavy on the Fed and bond yields. It's been an unprecedented start for bonds. What are usually a steady and safe asset class have been the source of pain. Actually, this last week, stocks and bonds flipped, where bonds are actually performing worse on aggregate than the broader stock market. So we're going to be looking at performance, talking inverted yield curves, and backing that up with evidence. So again, this is not a prediction. This is just a collection of charts that I find interesting and thought. Again, I don't have a script. I'm just going to be talking. Hopefully we'll keep it to under 30 minutes and you find some value in this. So let's get to it. I'm going to share my screen and you should see that. All right, so I apologize for the blurriness of this graph. This is the only graph that's like this, so just be patient. So this is the 10-year break-even inflation rate percentage. As this line goes up, the worse inflation is essentially. So this line going up is bad, and you can see there's been a few dramatic increases in inflation over the past couple decades, most notably in 08 to 09, and then again coming off the COVID low. So as far as the data that we track, inflation has not subsided. Of course, the war between Russia and Ukraine has added fuel to this fire. So a lot of different factors are converging. We're coming out of a global pandemic. Supply chains are still mucked up. If you've tried to order anything the last year, really, plus it's been very difficult to get. And now you're seeing people going back to being more mobile, and lo and behold, they're greeted with their daily commute with more cars on the road, but also higher gas prices. So again, this is just a perfect storm converging to make inflation run hotter than it has in some time. So let's get off of this monstrosity of a blurry chart, and these will be more clear. Okay, so we talked about gas. So, one thing that I like to do is, I know there's a lot of noise around this recent move in gas prices. And again, a lot of charts look like this coming off COVID, the COVID low, and then spiking higher. But it's good to have context too. So yes, gas prices are higher. They're putting a pinch on an already stretched consumer. But when you zoom out a little bit, you quickly realize that fluctuations in gas prices are completely normal. Again, I'm not trying to minimize this move. It does not feel good. It's ill-timed with all the things that I just mentioned. And again, this does not do anything to quell inflation, which I think the Fed, to make their job a little easier, would do well to get some good news on the inflation front. And it could be a ceasefire between Russia and Ukraine to have all of these trends that have happened over the last 30 days of the war quickly reverse. I'm not saying that's going to happen, but that would be a victory in the Fed's eyes. So supply chain pressure is something that we track because we're looking for the canary in a coal mine, if you will, as to when would start to subside. And we've pointed to this, a variation of this chart before, and this is basically the shipping costs between Shanghai ports and ports on the west coast of the US, so Shanghai to LA. And this is basically the cost per container. And again, as this moves higher, all of these increased costs are flowing through from businesses to the consumer and fueling inflation. So this is actually a good sign to see this come down about 20 or so percent. A meaningful move lower, again, would be another small victory for the Fed and make their job a little easier because they are in a very tough spot. And Treasury yield. So this is a chart of the 10-year US Treasury and changes in yields over a rolling 160-day period. So 160 days, what is that? 5 months or so. So you can see we've outlined some of these large moves up. So when this dark blue line is moving up, that means Treasury yields are moving higher. And you can see how noisy the 80s were. And this is no surprise because inflation was out of control in the mid to upper teens. And you can see these wild swings equate to a volatile inflationary environment. In the more modern era, if you will, inflation's been in a tighter range, and bond yields have traded in a tighter range. But there has been spurts where US bond yields shoot higher, and a move like this, like we had in 99 or 2009 or 2013, or even most recently in 2022, does not feel good because this does shock and stress bond portfolios. So just to remind you, as bond yields go up, bond prices go down. So this rapid move over the last couple months, where we've seen the 10-year move higher by 1.26%, that's the source of a lot of the bond price pain. And these moves are often mirrored with higher inflation and more aggressive Fed policy. So as the Fed looks to increase interest rates, bond yields will react accordingly. And over the last week, the Fed has become a little more aggressive in their language, and the market is pricing a more aggressive Fed rate hike arc, if you will, which again, this does change over time. So while bond yields are moving higher, while the Fed is talking tough on inflation, it looks like rates, at least on the short end of the curve, are going to go higher. Those expectations can change as market conditions change. So again, don't go extrapolating current Fed policy or what's going on in financial markets and economics. Don't go extrapolating that into the future, because these things can change quickly. So that was the 10-year. This is the 2-year yield. So same song and dance here. Again, the 80s were really messy. So instead of 10 years, this is the 2-year maturity track. And there's a couple things to point out here. One, again, the 80s were very messy because inflation was all over the place. But you'll notice these swings up until recently have been much more quiet. And I think that's important to point out, because again, the Fed can control the short end of the curve, and it makes sense since what the Fed does and what they say is closely correlated to this line here. Back to my previous slide, the Fed can't control the longer end of the curve, which is why this is much more noisy and choppy. So back to my comments, the Fed has gotten a little more aggressive in their language the last week, and that corresponds to this rapidly ascending line, which equates to higher bond yields on the short end of the, okay? So across maturities, whether you're talking 2-year at the front end of the curve or 10-year at the longer end of the curve, have gone meaningfully higher. And that has not been good for bond prices. And now the hot talk of yield curve inversion is coming. So a yield curve inversion is basically when the shorter end of the yield curve, so if this is the yield curve here, when the shorter end moves higher than the long end of the curve, okay? That's historically bad for credit markets. It's bad for the traditional function of borrowing and lending. And it has historically signaled signs of economic stress, and yield curve inversions tend to precede recessions. So if you've caught our last videos, we talked about the odds of a recession. This is another flashing, not inverted as of yet, as of this recording, which this is Tuesday, the 29th, but we're getting close. So we're here. A true inversion would be like this, but we're really close. You can see the last inversion that we had was, what is that? The second part of 2019. And this did precede a recession. So this dark gray line is a recession, but you have to be careful with cause and effect. The recession happened because there was a global pandemic, not because the yield curve inverted in 2019. So that's where things break down a little bit. But historically, a yield curve inversion does tend to slow economic activity. So that's just something to be mindful. A yield curve inversion can happen, and then a recession won't come for 3 years. So it's not a very good timing tool. It's just another data input as we're evaluating the landscape. And for those of you that want to read further on yield curve inversions, I'll include a post that I wrote in 2018 that breaks it down. I'm going to grab a swig of water here. Okay, so we're going to get into what flat yield curves, what inverted yield curves mean for stock prices. We're going to get into what negative bond returns the first quarter of the year mean for future returns. So this is a cool chart, and I'll talk you through this. So I just showed you the spread between the 2-year and the 10-year, right? So again, as this spread moves to zero, that basically means when you subtract the 10-year yield from the 2-year yield, a flat yield curve would be close to zero, right? If the 10-year yield is 2.5% and the 2-year yield is 2.5%, the difference in those two numbers is zero. So that would be a flat yield curve, right? A negative number dropping below this zero bound would be an inverted yield curve, where again, when you're subtracting the 10-year from the 2-year yield, let's say the 10-year yield is 2.4% and the 2-year yield is 2.5%, that would be an inverted yield curve because the 2-year is greater than the 10-year. Okay, so when that happens, and it hasn't happened that many times since 1978. So we're going back to 1978, tracking S&P performance, 1 month, 3 months, 6 months, and 1 year after a yield curve inversion. Okay, so once the yield curve inverts, what is the S&P performance for these various timeframes? And there's a caveat here. 1994, we came close to inverting, didn't quite invert. We'll say tie goes to the runner. We'll count that as an inversion. So let's see. And again, 2022, we have not inverted for a meaningful period of time. I think we inverted for maybe a day, but then it reversed. So I'm not counting that. So let's count 1, 2, 3, 4, 5, 6, 7, 7, if I counted correctly. Yeah, 7. All right. So the 7 times since 1978, the yield curve inverted. These have been the future returns: 1 month, 3 month, 6 month, and 1 year. And you can see, although yield curve inversions tend to precede recessions, these equity returns are not that bad. In fact, they're all positive, or mostly positive. So this is just the average. There's a few red numbers in here, so it's not like you can set your watch to this and count on positive performance, but there's more positive instances than negative, okay? And then if you're into range of outcomes, the max gain after an inversion during these periods, 3% to 34% on the upside, and basically flat to negative 22% on the downside. Okay, so looking at the average return 1 year later for the S&P, once we get an inversion, is about 13%. That's higher than the historical average. Again, not promising this is going to happen, but we're a big fan of evidence. So there's the evidence. And this is a small sample size too. So yield curve inversions don't happen that often. And it's not just the US where yield curves are moving higher, getting flatter, getting close to inverting. So this is an aggregate of 15 developed countries. So some of the largest countries on planet Earth. So think Australia, Greater Europe. I know Europe's not a country, but Germany, Spain, England, yada, yada. And then Canada, Australia. So this is an aggregate of the yield curve going from 1 year to 30 years. And I know this is kind of a chart crime here and tough to read, but the takeaway here is, coming off this COVID low, right? Most global bond yields have moved higher across maturity. So this is not isolated to the US. Sometimes I think people think the US operates in a vacuum. This is still very much a global economy. Capital flows to where it's treated best. And this is a nice look at the global bond yield landscape. So this goes back to 2014. And again, I'm a big fan of context. So although this move doesn't feel good, you run this back and yields are at basically where they were in 2018. You go back before that, all the way through 17, 16. So the absolute levels are not meaningfully different. In many cases, they're the same. What's uncomfortable for people, what's uncomfortable for markets and central banks around the world, is this rate of change. This rate of change is a pretty big move for sovereign bond. Okay, so this is something to keep an eye on. If inflation becomes a multi-year problem and we're getting unexpected higher inflation, you would expect these lines to continue to move higher. Now, most people would say, hey, Nick, isn't that bad for bonds? It depends on how you're positioned. So you see the darkest gray line is a 30-year bond. That can experience greater pain than, say, a 1-year bond, which that doesn't really play out here. But if you're locking up your money for 30 years, let's say, and inflation moves meaningfully higher, bond yields move meaningfully higher, well, you're locked in for 30 years at a lower rate. The price of that bond in general, all else being equal, is going to fall faster than, let's say, a 1 or 2 year bond. So we want to be mindful of our fixed income exposure. We're not going out and buying 30 or 50-year bonds. We're trying to be flexible, owning shorter term bonds. The furthest we go out on the yield curve is 7 to 10-year US Treasury. Okay. So ideally, you would want to have exposures across 1 to 3 years, and then in that middle, 5 to 7 years, and maybe some in 7 to 10 years. But unless you have uber conviction that bond yields are going to go down and inflation is going to subside, shoveling money into 30-year bonds is a risky proposition. And I'm a big fan not turning a traditionally safe asset class like bonds into a risky one. And I think that's what you do when you take these active bets on the longer end of the yield curve. Okay, So this chart, we're tracking basically a snapshot of the aggregate US bond market. So the Bloomberg Ag Index, most popular US bond index. And we're saying, what are the years with the worst total returns for the Barclays Index through March of 24? So through March 24th, what are the worst years? And we see that listed here. So 92, 94, 96, 2018, 2021, and 2022. You can see the corresponding color. So bonds in all those years got off to a rocky start. 2022, unfortunately, is the lost leader here. So taking a snapshot from March 24th, what are the future returns given the poor starts to the bond index in these 6 years? And you can see, with maybe one exception, so 94 was kind of flattish, but it didn't get worse. Most of these returns started to move higher. So a few things are happening here. One, for bonds, you're still getting paid interest income regardless of what bond prices are doing. As long as the bond doesn't default, you're still getting interest income. So that's helping to smooth this out over the course of the rest of the year. So that's the first thing. But the other part of this is price action. So 1992, for example, bond yields must have gone straight down, or they did go straight down, and bond prices went up, boosting total returns. So you're getting the interest income, bond prices moving up as yields move down, equals a higher line for the rest of the year. The same thing happened in 96, and the same thing happened in 2021 and 2018, but to a lesser extent. We finished higher in every instance except for 1994. So, if you're going to draw any conclusions from this line, history has shown when bond prices get off to a horrible start, usually the rest of the year is a little bit better. But again, this is a small sample size. Wouldn't draw any absolute conclusions from this. Now, the same question for stocks. When bond prices are poor to start the year, how does the S&P perform for the rest of the year? And again, here's 2022. So again, this is the S&P. But we're tracking the same years, same poor starts for bonds, but instead these lines equate to the S&P 500. So you can see this has been an odd year because stocks and bonds have gone down together with this orange line. Stocks have started to bounce back. Again, taking a snapshot from March 24th, with the exception of 2018 and 1994 was flattish. So 2018, you got the taper tantrum. If you don't recall that, the Fed was like, we're hiking no matter what. The market said, no, you're not. Market threw a tantrum. The Fed actually started cutting rates. So that goes back to my comments. The Fed can quickly change course if the market throws a tantrum, which in 2018, the market threw a tantrum. Fed changed course. But again, most of these lines trend higher. This is not a promise of what happens next. I just find it interesting. And there's a general theme as we highlight years with poor performance. Poor performance tends to precede better performance. So that goes back to having a framework for making decisions, not making emotional decisions. I think staying the course can be decent advice. It can also be lazy advice. And again, I have a blog post about when staying the course is good advice and when staying the course is bad advice. Perhaps we can link that as well in the video notes. And then this is something that I find interesting. So what this is tech sector performance. So just technology sector in the S&P during and after a 10% decline in the ETF TLT. The ETF TLT is a ETF that contains U.S. Treasury 20-year bonds. So U.S. Treasury bonds, 20-year plus maturity. So longer dated U.S. Treasury bonds. And what we're tracking is when bond yields move higher and there's a 10% decline in that ETF TLT, what does the tech sector do? And why this is interesting, there's this popular narrative that higher interest rates are bad for technology stocks. And you could go back the last 2 years as bond yields have kind of shot higher. When the NASDAQ is selling off, a lot of talking heads on Bloomberg and CNBC and analysts will say, well, that's because higher bond yields, higher longer-term bond yields are bad for tech stocks. But when you actually look at the performance, it's not the case at all. So again, we're going back, and there's 1, 2, 3, 4, 5, 6, 7 instances where we can actually see future equity market performance after long-term bond yields go up and this ETF TLT goes down by 10%. In the short term, so 1 month, 3 months, 6 month, 1 year future performance for the technology sector. In 1 month, the numbers can get noisy, right? And we've seen that this year where bond yields gone up, TLT's gone down, stocks have gone down. But as you move out, as you get to 6 months and 1 year, performance is really good. Average return between 20 and 23%, and it's positive 100% of the time. And I keep saying this, but I don't want to get in trouble by compliance. This is not a promise. You can't set your watch to this. I just find it interesting that talking head narrative, popular opinion, doesn't stack up with recent history. That's all I'm pointing out. So this is an important lesson on many fronts because there's a lot of bad information out there. And part of what a professional investor does is filter out the signal from the noise. There's more noise now than there ever was. You know, in 1980, you can get your information from a handful of sources. The sources of information you can count on one hand. Most people got it from a newspaper. Now there's newspaper, there's 24 coverage on CNBC and Bloomberg and social media, your neighbor, your neighbor's friend, your family. Everyone has an opinion. There's newsletters, there's email newsletters. There's so many sources of information. You would do well to build yourself an information filter just because there's a lot of nonsense out there. There's a lot of people selling their book or selling a newsletter, a lot of people with a loaded agenda. We prefer evidence. I'm not bullish. I'm not bearish. I take my cues from the market. I have an information filter, and I'm looking at things through an empirical evidence lens. That's all I care about. I'm not anchoring to an identity. I'm not wrapping up my ego or self-identity in a bearish forecast or a bullish forecast. That's the foundation our whole investment process is built on. And I can tell you in the last 2 years, when nothing has made sense, it's been really nice to fall back on a framework. Okay. I'll chill out and get off my soapbox, but I see a lot of investors making mistakes and allocation changes based on noise rather than a signal. And I don't want to overstate the signal. There's no signal that says, hey, Nick, it's all clear to take risk now. But I think when you stack up empirical evidence, empirical data, you can start to make better sense of what's happening and make better investment decisions. Okay. So I've highlighted why investors feel worse now than they have or than they did during 2020. And I think this is a big reason why, in addition to the other reasons that I outlined, where, you know, performance has been good the last 12 years. It's bad now. People aren't used to that. They don't like it. People FOMO'd into work from home stocks and technology stocks. That's been the biggest source of pain. This is the third reason where, and this applies more to conservative or investors that are retired or about to retire. Bonds aren't holding up their end of the. And as I mentioned, bonds are actually, as of this recording, performing worse than equities. So it's very rare, as you can see here. So this is just total return of a 60-40 portfolio. So 60% stocks and 40% bonds through the first quarter of every year going back to 1977. So we're just taking a picture at a 60-40 portfolio's performance through the first quarter since 1977. And we can count almost on one hand. You can count on one hand. 1, 2, 3, 4, 5, where performance is worse than 5%, let's say. You know, there's been a few other instances where performance has been a little less than 5%, but this has been one of the worst starts for a 60-40 portfolio. And you can see just how many instances that is. It's very rare for bonds and stocks to move down together. Okay, so I don't think the 60-40 portfolio is dead. Again, I don't want to draw any absolute conclusions from this. This is just an odd time where a lot of different factors that I outlined at the start of the video are converging. And this is just a very odd time. I mean, unless there's a parallel to coming out of a global pandemic, unwinding Fed stimulus, recessionary lights are starting to flash, and the Fed, oh, by the way, is going to start hiking. And there's a war that broke out. There's just not many lines to draw from history, given what's happening now. Okay, so this, again, is probably some chart crime, but I think it's interesting, and I'll walk you through this. So as our followers know, we're a big fan of tracking investor sentiment. So in other words, how optimistic or pessimistic investors are feeling. And for those of you that have been watching financial market movements over the last, let's call it 10 days, equity markets have really bounced back and bond markets have not bounced back. They've kind of swung the opposite way. Bonds are selling off, equities are racing higher. In just that week over week change from today's recording going back a week, the market was up like 4 days in a row, had a great week last week. It's off to another strong start this week. Look how much bullish sentiment has changed in over a week. So bull means people are feeling positive. Okay. The number of people that are feeling positive shot up 10 points in the latest investor bullish survey. Okay. So that's a pretty big move. So in 1 week, people are feeling much, much better given the recency bias of good stock performance. Okay. On the flip side, people are feeling less worse. So this bearish index has gone down, meaning people are feeling less pessimistic, right? So more optimistic has gone up, pessimistic has gone down. So people are feeling better. So after these large swings in people feeling better and less people feeling worse, if that makes sense, how does the S&P perform? And you can see it tends to perform a bit better a week and a month later. So this is all periods, right? Stacking up S&P performance for all periods since inception. This is just when these large swings in sentiment happen. So these numbers up here are generally higher or are higher in the first week and first month that you get these switches versus history. What's interesting in a year later, after these large swings in sentiment, performance is actually, button flail. Let me go back. Performance is actually lower in 6 months, in 3 months, in 6 months, and in 1 year. So again, I mean, this defies what you would think, but again, this rhymes pretty much in lockstep. When people feel the best, future returns are lower. When people feel the worst, future returns are better. And when you get these swings where people are feeling better and less worse, future returns aren't negative, but they're less than historical averages. So again, this is just a different spin. We're looking at this from multiple ways, and there are exceptions. There's been some really good years like plus 25%, plus 22. So again, you can't set your watch to any of this stuff, but we're capturing trend and a snapshot of what's actually happened. And I find the investor sentiment piece fascinating. So that pretty much concludes my spiel. I hope I didn't talk too fast. I know I can talk fast. I know I can get on the soapbox. But if you have any feedback for us, if you have any strategies you want us to backtest or look at or evaluate, I'm happy to do that. If you have any graphs that you want us to include during next month, send them my way. You can email inside@pureportfolios.com and the team will get it. We always like feedback. We're here to make this about you. But I hope this provides some context in the way we think as professional investors. And I know I repeat myself probably from month to month, but I believe in our pillars. I believe you need a framework and a foundation for making investment decisions. So it's not like our approach changes from week to week depending on which way the wind is blowing. I think you need consistency. Some periods your approach is going to be in favor and you look like a genius. Some months and some years even your approach can be out of favor and you can look like an idiot. And there's no clearer example of that than the battle between growth and value, right? If you were a growth investor, which includes technology stocks over the past 10 years, you look like a genius. If you were a growth investor going into the tech bubble of 1999 and 2000, you look like an idiot. And if you were a value investor, you look like a genius. So, this all ebbs and flows. There's no black and white in investing. Things change, complex systems change. And I hope you got something out of this. And again, we're always open to feedback. Thanks for watching. Thanks for tuning in, and we'll see you next month. Bye-bye.